Millionaires will be made in the coming weeks as market volatility creates massive opportunities for smart investors. The recent tariff announcements have sent markets into free fall, with the Dow plunging over 900 points in a single day. But here's what most investors miss. Stock market downturns are where real wealth is created, and the bigger the decline, the bigger the opportunity, especially if you can be greedy when others are fearful. History shows that those who can navigate these choppy waters aren't just lucky, they're strategic. So in this video, I'll show you everything you need to know about this latest market panic, and which proven strategies could help you potentially profit from it. Your time is valuable, so let's get right into it. First things first, I'm not here to hold you hostage, so here's everything I'll cover in this video. The psychology behind trying to catch the bottom and why it's so seductive. What legendary investors like Warren Buffett and Jesse Livermore teach us about market timing. The hard data on market crashes and recoveries that few investors understand. Practical strategies that actually work during market downturns. And of course, a realistic framework for building wealth without needing to perfectly time the market. Let's be honest. We all dream of buying at the absolute bottom. It's the investment equivalent of hitting a home run. You buy when everyone else is panicking, then watch your investments soar as the market recovers. The psychological appeal is undeniable, but here's the reality. Even the greatest investors in history struggle with this. Benjamin Graham, the father of value investing, famously said that trying to time the market perfectly is a fool's errand. This isn't because these investors lack skill, it's because market bottoms are only obvious in hindsight. Look at what's happening right now. The market is reacting to the administration's massive tariff announcements, with imports from China now facing a staggering 145% tariff rate. Just last week, the Commerce Secretary indicated that the temporary exemptions for electronics and semiconductors are just that, temporary. The uncertainty has investors running scared, creating exactly the kind of environment where opportunities emerge. But here's the thing about market bottoms. They don't come with a notification. There's no bell that rings when stocks hit their lowest point. Instead, bottoms are typically formed amid maximum pessimism, when it feels like things could still get much worse. Take March 2020, for example. When stocks were down 30%, many believed we were heading for a depression that would send markets down another 30%. Yet that turned out to be the bottom. Or look at 2008. The market kept making new bottoms for months, faking out investors repeatedly before the actual bottom formed in March 2009. What makes this quest even more challenging is our own psychology. Studies in behavioral finance show that investors feel the pain of losses about twice as intensely as the pleasure of gains. This loss aversion makes it emotionally difficult to buy when markets are plunging, even though rationally, we know that's often the best time to invest. Now, let's look at how legendary investors approach market bottoms. Their wisdom offers a fascinating contrast in philosophies. Warren Buffett's approach is best captured by his famous quote, "Be fearful when others are greedy, and greedy when others are fearful." But contrary to what many believe, Buffett doesn't try to call exact bottoms. Instead, he looks for value regardless of market conditions. When the 2008 financial crisis hit, Buffett didn't wait for the bottom before investing. He started buying in September 2008, months before the market bottomed in March 2009. He didn't get the absolute lowest prices, but he found tremendous value because he focused on the fundamentals rather than perfect timing. Buffett's mentor, Benjamin Graham, taught a similar approach. He advocated for buying stocks with a margin of safety, at prices so low relative to their intrinsic value that even if they drop further, you're still likely to do well over time. This approach doesn't require perfect timing, just reasonable valuation discipline. On the flip side, legendary trader Jesse Livermore offered different wisdom. Livermore, who made millions shorting the 1929 crash, famously said, "Don't try to buy at the bottom and sell at the top. This can't be done, except by liars." His approach was to wait for confirmation of a trend change before investing. He would rather miss the first 10% of a rally to ensure the bottom was truly in. Peter Lynch, who generated a remarkable 29% annual return over 13 years running Fidelity's Magellan Fund, had yet another perspective. He said, "Far more money has been lost by investors trying to anticipate corrections than has been lost in the corrections themselves." Lynch's point was that staying out of the market for fear of a downturn often costs more than experiencing the downturn itself. These contrasting approaches reveal an important truth. Successful investing doesn't require perfect timing. but rather a consistent strategy that works with your psychology and investment goals. Now let's examine some hard data on market downturns that few investors truly understand. Based on historical patterns from 1942 to today, bull markets last about 4.3 years on average, while bear markets last about 11 months. The average bull market delivers around 150% in total returns, while the average bear market sees roughly a 32% decline. This means bull markets last 4.5 times longer than bear markets and return about 3 times more than bear markets lose. This asymmetry is why long-term investors succeed. Markets spend much more time rising than falling. The COVID crash of February 2020 tells us something important about market psychology. A 34% decline in just 1 month, averaging a 1.5% drop per trading day. That's an incredibly difficult environment to buy into, even when you intellectually know it's likely a good opportunity. While the shortest bear markets concentrate panic selling into weeks, the average bear market actually takes around 13 months to bottom and 24 months to recover. That's why keeping cash on the side and dollar-cost averaging is so important. Another critical data point: 8 of the 11 bear markets since 1942 took place during recessions. With the current tariff situation potentially slowing economic growth, this historical pattern becomes particularly relevant. According to CNN's Fear and Greed Index, we're currently in extreme fear territory, historically a strong indicator of potential buying opportunities, even if not the absolute bottom. So what strategies actually work during market downturns, like the one we're experiencing now? First, dollar-cost averaging consistently outperforms trying to time the market. Research consistently shows that even investors with perfect hindsight would struggle to beat a disciplined dollar-cost averaging strategy. A famous study titled "Even God Couldn't Beat Dollar-Cost Averaging" found that investing a lump sum at the absolute bottom of each year, which would require divine foresight, only marginally outperformed simply investing the same amount each month regardless of market conditions. Why does this work? Because by investing regularly, you naturally buy more shares when prices are low and fewer when prices are high. Over time, this lowers your average purchase price. Second, focus on quality companies with strong balance sheets during downturns. When markets panic, they often throw out high-quality businesses along with everything else. The current tariff situation might create special opportunities in companies that are less dependent on Chinese manufacturing or those positioned to benefit from reshoring. Third, maintain a watch list of great companies you'd love to own at the right price. Market downturns are like sales at your favorite store. They give you the chance to buy what you've always wanted at a discount. When a company on your watch list falls to your target price, you'll be ready to act decisively. Fourth, consider a barbell strategy. Invest some money now while keeping some in reserve. This lets you benefit if we're near the bottom while giving you dry powder if markets fall further. Research shows this approach provides both psychological comfort and solid returns. Fifth, remember that market timing isn't about making one perfect decision. It's about making a series of reasonable decisions. Rather than trying to nail the exact bottom, consider scaling into positions gradually as markets fall. Let's break down the current opportunity more concretely. Markets have been rattled by significant tariffs: 145% on many Chinese goods, 25% on Canadian and Mexican imports that don't meet trade agreement requirements, and across-the-board steel and aluminum tariffs. These policy changes have created uncertainty, and markets hate uncertainty. But uncertainty creates opportunity. The S&P 500 is now trading at a forward PI ratio below its 5-year average, with many quality companies available at 20 to 30% discounts from recent highs. Historically, when markets experience this level of fear, subsequent 12-month returns tend to be above average. Rather than obsessing over the exact bottom, focus on finding great businesses facing temporary challenges. Companies with pricing power, domestic supply chains, or essential products are particularly well-positioned to weather this storm. Remember, the goal isn't short-term timing perfection. It's building positions in excellent businesses at reasonable prices that can compound your wealth over decades. Significant opportunity, but several risks exist. Market volatility could intensify, stocks could fall further, and economic conditions might deteriorate. Global supply chains face challenges. The greatest risk is psychological. Can you maintain conviction if markets fall? Manage risks by sizing positions appropriately, diversifying, and maintaining liquidity. If you're finding this analysis on market timing strategies valuable, supporting the channel with a like or subscription keeps this research coming your way. Your engagement helps me create more in-depth content focused on practical investment strategies during challenging markets. Timing the market bottom is futile. Markets rise more than they fall, and disciplined strategies beat perfect timing. Tariff volatility creates opportunities, but requires process, discipline, and perspective. Don't ask, "Is this the bottom?" Ask, "Are quality businesses offering good long-term value?" Buffett bought quality at reasonable prices and held for decades. That's how real wealth is built.